We are about to begin another episode of the Prosperident webinar series. From their unique perspective as dentistry's embezzlement experts, Prosperident's team brings you information you will not find anywhere else. Now sit back and relax while Prosperident's Amber Weber, Wendy Askins, and David Harris address the issues that are important to you.
Hello and welcome to our monthly Prosperident meeting. We are super excited to have everybody join us. We have a very exciting topic today that we're going to be talking about. But as always, we love it when you guys ask us questions during and after the webinar. So please be an active participant tonight, and we welcome your questions. And if we don't have time to answer them, we'll take time at the end of the presentation to go ahead and answer them. Our series tonight is going to last about 75 minutes, and that includes our question and answer time. So we hope that you can stay and enjoy all the wonderful content we're going to bring to you tonight. It's new and exciting content that we have been putting together. Don't miss out on registering for next month. Master Your Practice's Finances. So, it's on May 20th. Because you participated tonight, you're already registered. But we're excited to talk to you about tonight's topic, how we have seen embezzlers think and act post-pandemic.
Thanks, Amber. This was a movie in the 1980s I liked, but I think it's described the last year for a lot of people really well also. I'm going to put together a couple of kind of frightening statistics and let you see how they come together. The first set of statistics comes from a survey that was done in 2019. And basically what it found is that there's a large subset of the United States population that's living more or less hand to mouth. 70% have savings less than $1,000, and 39% could not handle a $1,000 expense that they didn't expect. That's not good, but let me put this with it. In 2020, we had one of the biggest drops in employment in US history. And what's called GDP, which stands for gross domestic product, which is kind of a measure of the company's output, took the biggest drop since 1946. Well, what happened in 1946? It was the end of World War II. And that's when the economy was kind of moving from a war footing to a peacetime footing. And unemployment went through the roof. It had been around 3.5% before the pandemic hit. It went up to almost 15% at the peak, and it's come down somewhat, but still kind of high. And a lot of people were sort of kept afloat through this financially because of government money, but that's pretty much done now. So when we look at why somebody might steal, you've got a big subset of the population living hand to mouth on the one hand, and on the other hand, you have this sudden economic shock that meant that, for example, a lot of people working in dental practices had spouses that lost their jobs.
So let's talk a little bit more about why people steal, or the reasons that people steal. In the past, we've seen that really one of the main reasons is just basic greed. These are people that have champagne taste on a beer budget, or they want to live the lifestyles of the rich and famous, or keep up with the Joneses, whatever phrase you want to use, except for that they don't have the earning capacity to produce that type of income or that type of money for themselves legitimately. So what they begin to do is to go after the business owner's money, because it seems to be just free money that's handed to them, and they want that. People that steal from greed often have the idea that the business owner's success is primarily driven by their hard work. And so it's not fair that the business owner gets to drive a larger or more expensive car than they do, because they're the reason why that person is successful. The other type of category that we're seeing of theft is driven by need. And we're seeing this a lot of cases driven by need post-COVID. These are people who have had some type of extraneous negative life impact on their lifestyle. And it's not a matter of simply wanting to keep up with the Joneses or wanting better things. Now it comes down to basically being able to pay my mortgage, or my husband lost his job and, you know, we don't have money to even eat. So, anyway, again, they see the money and there it is. And they're just driven out of need to do that. It's interesting that between these two separate groups of causation, we see that revenue theft versus expense side theft varies a little bit. The person that's operating out of greed will go primarily for revenue. That would be patient payments, insurance payments that are coming into the office. Whereas a person from need that steals out of need, they'll go after those types of payments as well. But then they also have a higher rate of stealing from the expense side, which logically would be maybe paying their car note out of the business bank account, or paying their credit card bill from the business bank account as well. So those are some of the issues that we're facing lately. It's interesting to me. I want to tell a funny story about Dave. When we first met, and we were discussing this because it's a well-known theory by a criminologist named Creasy. And David asked me, Wendy, would you ever steal? And I said, absolutely not. I would not. I've had plenty of opportunities and I wouldn't do it. And then he said to me, what would you do if there was a famine and your family was starving? Would you steal? And I said, no. And then he kind of went on with it a little bit more. And he said, no, wait, your family's, your husband's losing weight. You're losing weight because you're starving to death. Would you steal? And I finally had to come around and give him the answer, which is, yeah, I would. So that's kind of an example of a person stealing out of need. No matter how moral we think we are, or put in certain circumstances, every one of us could be driven to a point where we would be willing to steal from somebody else, be it food or money or whatever. But you know, a myth that we hear quite often is, well, if I pay my staff members well, they won't steal from me. If I bonus them well, they won't steal from me. And we're going to cover that a little bit later in this presentation, because that's a myth that we need to dispel.
Thanks, Wendy. And you're so right. You know, at some level of financial pressure, everybody's ethics become pliable. That level is different for different people, but it's there in all of us. And the pandemic of the past couple of years the past year has created some desperate people. You know, and in the mind of these folks, their backs are against the wall and they're stealing really to survive. So what are we seeing in 2021? And Wendy and Amber and I, when we were planning this presentation, sort of went through the cases that we've worked on lately and the ones that we are working on, and tried to draw the commonalities from them. And the first thing that we all noticed was that there's more theft on the expense side. And Wendy gave you a little definition, but just let me step through it again. By revenue theft, we mean stealing patient payments or insurance payments from a practice. Expense theft means causing the practice to pay out something that it really shouldn't. So tampering with payroll would be an example of expense theft. Another example is if there's a bonus plan in place to manipulate it. And we'll probably get Wendy to talk in a minute or two about a case she's working on now where there's just massive tampering with a bonus. And the other one that we're seeing that's relatively new, we call Amazon fraud. And essentially what happens here is somebody in your practice has control over the Amazon account, and you know, they need lawn furniture and they order it through the office Amazon account, which of course gets billed to the doctor's credit card. So that's the other type of fraud that we see now that really is emergent. On the revenue side, we also see some trends. One that we've seen is what we call refund fraud. And this involves patients who have credit balances. And in most states, the law gives you a fairly short period of time when you have to refund that money back to the patient. And sometimes the money goes somewhere that it probably really shouldn't. The second thing that we see is called virtual credit card theft. Virtual credit cards, a lot of you may have seen in your practice. So this is when an insurance company pays you by giving you this credit card number and essentially putting money on that card. And then what you do is you enter the card manually in your merchant terminal in your practice, and then the money moves to your bank account. So the insurance companies have found that this is administratively very convenient for them to use. There are a lot of issues with it, among others, that you end up paying a merchant fee. So every time somebody pays your practice by credit card, you lose, 1.5% or 2 or 2.5%, depending on what your arrangement is. When you get paid by an insurance company, and these are typically PPOs, so you're already taking somewhat of a haircut. And then from there, you run it through your merchant terminal, you lose a couple more percent. So these are a bad idea in a lot of ways, but they also tend to be big enablers for theft. So these are kind of the emergent patterns. And I suspect I'll get agreement from Wendy and Amber when I say it, particularly the expense stuff, which in a good year, in a year when the economy is booming, we tend to see not much of, is really coming out right now.
Yeah, definitely. So one thing we really want to talk about, especially post-pandemic, is how important true separation of duties is in your practice. So because a dental office has so many moving parts, you have to take care of patients, you have to take care of staff members, plus the revenue side and the expense side. We really recommend that moving forward, you really have a great, clear viewpoint with your team members and yourself on separation of duties. So, separation of duties serves two key purposes. For one, it's there to provide you assurance in your practice, where you can review, catch errors, and make sure there's oversight in the daily, weekly, and monthly things that go on in your practice. Realistically, a very clear, well-designed system for separation of responsibilities is essentially to protect your practice. So we want you to consider, three groups, three areas that you can use within your practice and your business to protect yourself. Number one is your team. So we want your team to be actively involved, just like you're actively involved. What happens, though, is we see a lot of team members, one team member being in charge of everything, right? So not everybody is actively participating and communicating to have a good separation of responsibilities. The first place that we want you to really look at, though, is ownership. It has to come from you, the doctor, and the spouse. That's where that review and oversight comes from. The other thing is a lot of these things that also help with accountability and true separation is outsourcing, the use of professionals who also help make sure that things are reviewed, reconcile, they catch any errors that you, your team, or any other people in your practice are helping that may have been missed. One way to look at this is you're the CEO of the practice. So the smaller the business, sometimes the more difficult it can be to have active team members completing tasks. So, the CEO of Home Depot has many more team members to easily divide certain tasks and duties that need to be completed within that business. So when you are a single practice owner, it's really important that you won't have as many team members, but you have great transparency and oversight, and you yourself are very actively participating in making sure those separation of responsibilities are clear and concise.
Amber, I love that you talked about catching errors, separation of duties, even to catch errors, as well as embezzlement. But because as an examiner, and I know you guys find this out as well, as an examiner, when I go through and I look at a data set and I start doing my own reconciliation, I find most of the time I find embezzlement. Sometimes I don't find embezzlement, but Almost always, I just find errors. Like, for example, a $100 check might be entered as 10 or vice versa. And the thought comes to me, there's evidently, if that can happen, and I'm seeing that as an examiner, it's a key indicator to me that there are no separation of duties. Only one person looked at that, number one, and number two, there was no balancing process that happened in that. So I love that you brought that up, because I think that's really important as well.
Yeah.
Well,
no,
and another
oh, go ahead, Amber.
Another thing I want to add also from my experience as an office manager in a smaller practice is separation of duties also is going to help you as a business owner determine areas that are going to require more training for your team. And if you have a small team, and require the need for additional services. Let's say insurance is a huge area that needs more time than the team members that you have. Those are things that you can outsource. And one of the main things that I see happen, especially with office managers who wear a lot of hats in the practice, a great clear separation of duties also is going to help with staff burnout, right? To where they're not doing 10,000 things at once and everything's on their shoulders. So it's also going to help you have a great tool in your practice to help your team grow and not feel like all the pressure is on them as well.
That's insightful. Thank you.
Yeah, I'll add one more thing. So a question I get asked a lot is this, I own a very small practice. I've been told that I need to divide up so that the same person doesn't receive cash, record the cash, deposit the cash, and reconcile the cash. And sorry, when I say cash, I'm talking incoming funds, because cash checks, credit card payments really are all stealable by a thief. But how do I break that up so that I don't have one person performing all those functions when I only have one person at the front desk? And that's a very logical, reasonable question. And when Amber put up the three categories here, really what she's doing is giving you the answer. In a small practice, if you are the practice owner, you probably have more financial responsibility, more financial duties than you might in a bigger practice where you have more employed staff to spread things around. And of course, the other possible out here is there are some things that can be outsourced. And we work with several specialized dental bookkeepers, and they're very happy to take your practice management software results each month and compare what your software says was received versus what actually went in the bank.
That's the key.
Yeah, it is.
Mm-hmm.
And there are fundamentally, if I'm stealing on the revenue side, there are three ways to do it. If there is no separation of duties, if I am the only person touching this stuff, then I can just steal money from the deposit. I don't need to do anything exotic in your practice management software. I can just take money from your deposit, and probably nobody's ever going to know. The second way that I can steal is if the reconciliation is done, let's say by you, but it's done based on what's going to the bank as opposed to what actually arrives there, then same thing. I can siphon off deposit and you won't know. And the solution there is that your comparison needs to be between practice management software and what actually went in your bank. In other words, what your bank statement or what your online banking says, not what a deposit slip that leaves your practice says. Mm-hmm. And the third way to steal is to get your practice management software to lie. And this is something we talk about a fair bit. It's not terribly hard to do. But as a thief, that will be my last choice, my least preferred way of doing things. I'd much rather just, stick my hand in the deposit and take away whatever sticks to it. So people like the outsourced bookkeepers can stop the easy theft, and then you have to deal with the more complicated advanced stuff maybe a different way. Wendy mentioned this one a minute ago, and I just want to tie back to what she said. Something that I hear a lot from people is, one of the ways that I protect myself from being an embezzlement victim is that I pay my employees really well. And I think in this context, really well probably means above the going rate for the local area. So, if receptionists in your area are normally paid $26 an hour, and you pay $30 an hour, it's tempting to think that that will buy their honesty. And surprisingly, there's very little research on this. Probably the most credible study was done in 2011. And it found two things. It found that if you paid people more, they were less likely to steal. Okay, great. It's the second part that is a little bit less pleasing, though. What the authors of this study found was that for every dollar in salary cost, they reduced the amount of stealing that was going to take place by only 42 cents. In other words, that paying people better to not steal actually cost you money in net more than it saved. So I'm not saying pay your employees badly because it's better. That's not always a good idea either. But the concept that we can buy their loyalty doesn't really seem to hold up in practice. And let's talk about something a little bit older. There was a guy named Frederick Hertzberg, and he was in 1959 what was called an industrial psychologist. And he had some groundbreaking kind of research. And what he did, and I remember studying this guy back when I was in business school in the 1980s, and his stuff is still taught in business schools. He said that there are two kinds of factors. There are dissatisfiers and satisfiers, and certain things only have the potential to make people unhappy if they're not done properly. And a different set of factors have the ability to make people happy. So the kind of things that he listed as dissatisfying factors are things like how much people are paid. We think money is a motivator. Here's the problem with money. I start work at your practice as a hygienist, and I'm paid $52 an hour, which is good money. And the first paycheck I get when I'm out of dental school, I say, wow, this is wonderful. And I take my parents out to dinner, and, I kind of live it up. Do you think I feel the same way on my 8th paycheck or my 20th paycheck or my 50th? No way. At that point, my lifestyle has moved up to equate to my income. I've now got a car payment, and I've had to start paying back my student loans and stuff. And I don't really get that feeling of getting ahead like I did when I got that very first paycheck. So money becomes a dissatisfaction factor. In other words, most people don't derive a whole lot of satisfaction and pleasure from the amount they're paid. They just kind of expect it. The satisfaction factors are things like achievement and responsibility, and they're a little bit less tangible. If you've ever looked at Maslow's hierarchy, you'll see a lot of similarity between what Hertzberg did and what Maslow did. Maslow suggested there were lower order needs that had to be satisfied first before higher level needs, and the highest need in Maslow's hierarchy is called self-actualization, until those things can be satisfied. So you can make up your own mind about this, but there's a lot of evidence that says really that you can't buy the honesty, or for that matter, even the satisfaction or happiness of employees with money. That has to come from other places.
Dave, I love it when you pull out the psychology studies.
Mm-hmm.
It just makes me warm and fuzzy on the inside.
Well, every private investigator is an amateur psychologist, Wendy. You know that well.
Yeah. Plus, I spent many years doing studies and going over those. So it just makes me feel young. Anyway, okay, let's talk about payroll. Speaking of paying employees, these are 3 vulnerable areas of your payroll, or shall I say payroll processing, that can be manipulated. Number one, which I hear all the time from business owners, is the timekeeping accuracy, meaning inflated hours within the computer system, or however you're keeping track of, or employees are keeping track of their time. Number 2 is hourly rate. And I'm going to talk a little bit more about this in a second, but there are different ways that an employee who is processing payroll can increase their hourly rate without you ever knowing. And that's kind of where I'm going with that. And then also, one of the main manipulation tools I see is the failure of the two separate payroll components to automatically draw information from each other. So, for example, what I mean by that is you have your employees keeping track and logging in, logging out of their time, or keeping time in, let's say, your computer software, like maybe your Dolphin software if you're an orthodontist, okay? But when it comes time to submit that payroll, either by written check or to a third-party processing company like ADP or Paychex, they have to be manually entered into the program. So those systems aren't automatically joined together. So some recommendations to kind of close up this vulnerability or these gaps is, number one, to use a biometric reader, such as a thumbprint reader. This stops other employees from logging in for their work BFF. If, their work BFF is going to be about 30 minutes late to work, and it's like, would you please log me in anyway? So it stops that from happening. And another thing about that is, I know, because I've done enough payroll reconciliations and I've done enough payroll cases, there are times, multiple times, when employees just don't log in. They forget. So they'll go ahead, log into the computer system, and they'll begin working immediately. Then maybe at lunch, when they go to log out, it hits them, oh my God, I never logged in the first place. So then you have to go back and manually change that time. I think a great suggestion is, when that happens, for the owner of the business to be notified, and the approval actually come from the owner, to have that specific time entered. Because remember, when that happens, you're really just, it's very hard to prove what time an employee was at the office that day. And having done payroll examinations, again, there are lots of different things in your computer system that can tell you that, but there are also a lot of variables based on that as well. So I recommend having that change of time submitted to the owner, preferably on a daily basis. And if not on a daily basis, at the very, what I want to say, maximum, the once a week, at the end of the week. And here's why I say that. So the first Monday of the pay period, I come in and I forget to log in. Well, am I gonna remember 2 weeks from now when I came in? I'm not going to. So it's just real easy for me to say, oh, well, I came in at 7:30 that day because I normally come in at 7:30 that day. Well, that may have been a day that I came in at 10 because I had something to do, I had an appointment that morning. So try to get those daily, and if not daily, at least every week. Another option is, or another recommendation is, hourly rate lock. If you're submitting your payroll through a third-party system like ADP or Paychex, many business owners are not aware that those programs actually have rights levels the same way that your computer software does. So, for example, you can set up the rights for one of your staff members to enter the hours of all of your employees, but not view or change the pay rate of that employee. You can set that up for owner specificity so that only the owner can be willing or can be doing that. And then also, I hear a lot about, people say, well, I can see if embezzlement is happening because I can look at my employee cost versus my collection percentage that shows up on my P&L. And that is truly a very important metric that you need to measure on your P&L. I know that's like geeking out on accounting stuff like I do, but it is, I mean, it's crucial that you know that number to run a successful business. I believe that if you know what your average percentage is of staff cost versus revenue, if you know what the average of it is and you see a spike in it, for example, I had one payroll case where the doctor's staff cost to revenue was 35%. And I think everyone watching this webinar would agree that that is a really high percentage. So it can be an indication that there is some sort of payroll theft going on that you're not aware of. But we need to be very cautious because there are many, many variables that go into that calculation. And one of those variables may be impacting that rate. Dave, you're kind of passionate about that. Do you want to kind of go over that a little bit more?
For sure. I have a lot of people, particularly consultants, who swear to me that if an employee is padding the payroll, it will show up in this ratio of staff cost to revenue. And the problem with that is that a couple of things. First of all, every practice, and we all found this out very much the hard way last year, practice revenue is variable. Salary expense, not quite so much. So the average practice last year was off about 18% according to the ADA from what those same practices had been in 2019. And the question is, for those practices, how much did their payroll change? And sure, a lot of practices closed for 6 weeks and they furloughed some employees then. But I doubt that for most practices, your staff cost in 2020 was 82% of what it was in 2019. I just don't think that happened. So when you compare this ratio for 2020 to 2019, in most cases, the ratio is going to look worse in 2020. Now, we all understand that for a whole bunch of reasons, 2020 is going to be anomalous, and it's going to be like those pre-steroid testing athletic records, that all have a big asterisk by them now in the record books. It's going to be like that. But my point is this: your revenue can increase by 10% without your staff cost changing in most practices. It doesn't mean anything except that you're comparing a variable revenue with a relatively fixed expense. So I won't say don't look at this ratio and don't draw some conclusions about how well your practice is using its human resources, but it would take a pretty egregious payroll theft to make this stick out statistically to the point where you say, oh, somebody must be stealing from me in payroll. Let's talk about bonuses. And this is a topic I see a lot of discussion on in some dental forums that I belong to, and everybody's looking for that kind of elusive bonus formula that meets all their needs. And I've got to say, I think in general, the task of setting a bonus is tough. First of all, because running a practice is kind of a multifaceted activity. There are a lot of things that have to happen correctly to have a well-run, profitable practice. For example, you need the recall program to be effective. You need to be good at collecting money. You need to be good at getting patients who need treatment into the appointment book. I mean, there are a lot of moving parts. And what that means is that when you set up a bonus plan, you kind of have this trade-off of either I make the bonus plan relatively simple, which probably means that I focus on only a few of those many areas in the practice that have to happen successfully, or I come up with some really complicated bonus that nobody can understand. So here's the dilemma. Let's say that right now you perceive your problem is to collect accounts receivable. And you go to your staff and you say, all right, I'm going to put a bonus in place. And if we get our accounts receivable level down from where it is to where I'd like it to be, everybody will get a bonus. Well, there are two ways to get receivables down. One way is to collect the money that's outstanding. And the other way is to stop doing dental work. Think about that for a minute. So you put that in place for your staff, and the next thing they do is they drop everything else and they start trying to collect money. In the meantime, they're not making recall phone calls. They're not following up on patients with pending treatment who haven't been booked yet. They're not doing all of the other things that need to happen to make your practice have sustained profitability. So coming up with a bonus formula is challenging to begin with. And then you have to overlay on it this other set of complications, which is, what if people play games with it? Well, in my mind, one of the bonuses that is most subject to being played with is what's called a threshold bonus. And what this means is that there's some level at which the bonus kicks in or accelerates or stops. So, an example of a threshold bonus would be to say to your staff, if you collect more than $200,000 this month, I will put $5,000 in a bonus pool and divide it up among you, or use it for a continuing education trip to somewhere nice or something like that. That's a threshold bonus. So there's some number that we have to hit. So we're having this conversation on the 22nd of April. And if you have that kind of bonus, what's happening in your practice today, more or less, is that your staff are getting together in the break room and they're looking at each other and saying, well, how close are we? Are we going to make that bonus or not? And if you've already collected on the 22nd, if you've collected 195,000 and the bonus looks good, what do you think happens next? Now they start thinking about next month. In other words, we're going to make it this month. There's going to be $5,000 more that come in pretty much no matter what we do. But there's no real point in our collecting $230,000. It would be better for us to just cross the threshold and postpone that $30,000 until next month, so that next month's goal, which is going to be $200,000 again, is that much easier for us. So if they decide that the bonus is a slam dunk, they're going to stop trying to collect. Well, let's think about the other side, where on the 22nd of the month, the amount that's come in is $120,000, and they look at each other and they say, there's no way we're going to make the bonus. What's their behavior then? Well, here's the interesting part. It's exactly the same. There's no point in their busting their chops to get another $60,000 in this month, only to still fall $20,000 short and get no bonus. So if the staff decide on their 22nd of the month meeting that this month's bonus is hopeless, then let's stop trying to collect this month, and we'll again push collection off until next month and try to make next month's bonus happen, because this month's clearly is not. So a few things you need to do to make sure that your bonus dollars work for you the way that you want them to. The first thing is this. It's easy for staff to manipulate timing of events, whether it's on the revenue side or sometimes on the expense side. We can push timing of stuff around. If I really don't want to collect that money this month, I can certainly make it happen next month instead. One of the ways to deal with that is to use longer term yardsticks. So if instead of monthly targets, we have annual targets, now you're limited to what you can push around at the beginning of the end of the year, as opposed to having 12 opportunities to do the same thing. So longer term yardsticks tend to take away the potential for timing kind of manipulation. A second caution is, don't use gross production in any meaningful calculation. So we all know how this works. Most computer systems, when they bill at what's called UCR, usual, customary, and reasonable fee. In other words, your sort of theoretical fee that you would treat a cash patient for. And then if you're dealing with an insurance patient, typically there's an adjustment to get down to what the insurance company and you have contracted with. Gross production is the bigger number. What's called net production is the number after adjustments, or sometimes it's called adjusted production. That should be the yardstick for things like bonuses. Consider the case where you do free dentistry on a staff member and what happens in your practice management software. The way that shakes out is the practice management software initially uses UCR. So you do a cleaning that would normally cost a cash patient $250, and you do it on a staff member, EagleSoft or whatever you're using will clock up a $250 production, and then there will be a $250 adjustment. Do you really want to bonus your staff based on how much staff dentistry they did? It just makes no sense. So don't use gross production for any metric.
Dave, I have an excellent example of threshold bonus manipulation.
Okay.
Can I tell?
Sure.
Okay, so I just finished this case and I'm so glad because it was a really big one, very detailed investigation. Amber helped me with this case as well, my bud Amber. Anyway, so there was a DSO organization that was bonusing their doctor practice owners, partial practice owners, on what we call contract revenue, or we can call it production, just to make it simple. Well, what they had decided very fairly, in my opinion, was that because we had COVID to deal with and the lockdowns and the closing of businesses, that there would be 3 consecutive months out of 2020 in which they would take their annual bonus, but they would strip those 3 months out of the calculation because they knew that they were going to be low and there was no way that the other professionals could possibly bonus on that because they wouldn't be hitting their goals. So they stripped those 3 months out, and then they used a 9-month time period from the beginning of the year and then the end of the year, a 9-month time period to calculate the production, which would calculate their bonuses. There was one particular doctor who continued, according to the treatment notes, continued to see patients, continued to see new patients, continued to do records, and continued to start orthodontic patients during that 3-month time period where they weren't counting the production, right? Nobody was looking at those 3 months, but he held all of the production for that 3 months and put it in at the beginning of the 9 months, right? So, of the 9-month period that would be calculated. So this ended up being a shifting of contract revenue recognition of like 500,000, a little more than 500,000. So,
wow.
I mean, even again, I said that I get brokenhearted every single time I find an embezzlement case, but when I find business owners cheating each other or doctors doing that to each other, it really just rips my heart in half. So it was a very sad case, but.
And to be clear, Wendy,
we're very happy with our research and the outcome of the discovery.
Yeah, to be clear, the doctor didn't change the timing of what he did. He did the clinical work on schedule. What he did, though, was he did clinical work and then he didn't enter that work into the practice management software. He postponed entering the work until he was back into his bonus period. That's really what he did, and it was a massive manipulation. So. Yeah, let's, Amber, tell us about Wendy, tell us about Amazon fraud.
Oh, I will. I am so excited about this.
You're excited about Amazon fraud?
I am really excited that we have discovered Amazon fraud. I'm just sick sometimes. I know my mind is twisted. No, actually what I'm really excited about is this is a new type of theft that we haven't seen before. And I know I've got a case, Amber had a case, and there are a couple other cases with investigators in Prosperident right now. So I don't want to call it a new theft method because honestly, it's probably not. But Prosperident is the first organization to uncover when things like this do happen. And so now we've uncovered it. Okay, so basically, let me share the scheme with you. Little schemey girl here. Okay, so what the scheme is that someone who is logging into your Amazon account to order items for your office or for your business. And so they log in, all the information. We all know how Amazon works. I'm not going to go into that, but instead of shipping to one particular address, which is your office location, they ship to another address, which would be their personal address. Or in Amber's case, how many addresses did she have? Additional four different delivery addresses, right?
Yeah.
I'm sorry. Go ahead, Amber.
Well, it was interesting because when we started looking through the Amazon history, you could tell who's going to get the gift or the present, right? It's like, oh, well, this is for personal and her kids, or this was, for another friend, or this was for her friend on the side. So yeah, it was really interesting because you started to see a pattern of what was purchased and where it was shipped, which was another interesting thing to look at also.
Yeah, that's just so bold, isn't it?
Yeah.
Anyway, okay. So here are some recommendations to that. Number one, be aware that it can happen, and it does happen because we're seeing it happen. Number two, set up a separate Amazon account. One of the issues that makes this scheme possible is because on your credit card statement, when you get that statement, it simply says Amazon on there. It doesn't say what you ordered. It just says Amazon and an amount of the charge. When you go back and look through that, it's hard to tell if the doctor is commingling personal purchases with business purchases on not just on their Amazon account, but even on your regular credit cards account, like your Visa, MasterCard, whatever. If you're commingling those expenses, you need to separate that. So one option would be to create a separate Amazon account that is only for ordering business supplies or whatever you order for your business off of Amazon. Another thing I think is absolutely crucial is I hate to add more work to our clients or recommend more work for people to do in their review at the end of the month, but I think this is critically important. And in the end, it's really easy. Go into your Amazon business account at the end of every month and do a quick scan of everything that has been ordered from that account. So let's say you're scanning through and you're seeing business supplies like paper and paper clips, whatever, dental supplies as well now on Amazon. And let's say you come across a Traeger barbecue grill or a Traeger smoker, right? You absolutely know that that was not ordered for your office. So bingo, just that quick. You know that's a fraudulent purchase. As well, you can look at the delivery addresses and see exactly where that went. So anyway, this is a good thing. Yeah, watch the delivery addresses. Thanks. Go ahead, Amber.
Well, I wanted to add one thing too in my experience with Amazon. What I also started noticing is time of day that things were ordered.
Oh yeah,
so
that's good.
It was really interesting because if it were office supplies or things like that, it's like, are they going to order, this Blackstone grill for the office at midnight on a Saturday evening, so that was another kind of interesting thing, was to look at the time of day that they ordered the item, right? So even if they say, oh yeah, I went ahead and ordered that printer for the office. Really? At Saturday morning at 2 a.m. in the morning, you decided I needed a printer at the office? Like, so interesting thing that I saw in my case, it were really odd times of the day as well. So
I mean, that's why I love what we do. It's so amazing. And Dave, that's why I was talking about the psychological studies you were talking about. I mean, it's just fascinating what people do. Anyway,
yeah.
Sure is.
Well, with my experience, and Wendy, you and I went through this, she ordered 3 different barbecue grills over like 2 months. And if you look at the time of day that she ordered them, I'm like, she must have been watching like an infomercial on Saturday on these really fancy grills and decided, shapes and sizes of these grills or something, and I'm gonna see if Amazon sells that, you know?
I'm gonna use the doctor's account to buy that $1,000 grill. Oh, cool.
Yeah.
Ship it to my girlfriend's house.
All right, Amber, tell us about refunds.
Something that you talked about earlier, Dave, that post-pandemic, we are seeing an increase in refund fraud this year. So the main thing is we always want you to do a refund by check and never a credit card. Now, in my experience, that can sometimes be difficult, right? Because a patient wants their refund right now. But we want to make sure that the refund always goes directly to the patient and there's documentation. So this is another component where the true separation of responsibilities comes in, where you have that system down with your team members. And that is a clear policy that your patients are aware of, your team members are aware of, and you are aware of, that refunds are done by check, never credit card. The other rule of thumb is, as a producer in a dental practice, patient credit should be an exception and not the rule. So, you know, as important as it is for us to collect money from people that owe us money for the treatment that we have given them, it is just as important for you to know and understand on a regular basis who your software says you owe money to. The reason this is so important is a lot of credits that a patient's account, if they're not reviewed with oversight on a regular basis, many of those credits arise from lack of staff knowledge. Not that they did anything wrong, just error in training, right? So you actually don't owe these patients or an insurance company that credit. The other key thing here is, if you are going to be issuing a refund to a patient or a dual insurance patient, this is where you really need a clear, written, documented system that you, as a practice owner, and another team member, where that transparency comes to place, you review this together and make sure that that is truly a credit that should be on that account. So always, always review a patient account before issuing a refund. And once that account has been reviewed, as an owner, you need to control how that goes out. Meaning, a refund to a patient should either go through you or an outsourced person like a bookkeeper or CPA, never an in-office person that has signing rights. Because like I said, we want to make sure that refund is documented and it goes directly to the patient, and you are the one who has approved that refund for work that you have done for that patient to go out to your patient. Here's the other cool thing that we always recommend. You put that refund in the mailbox yourself. So if you write that check, you make sure that you are the one that drops it off at the mailbox. Don't allow any team member to go ahead and mail that. You want to make sure it goes where it is supposed to go.
VCCs, virtual credit cards. Dave explained these a little bit in the beginning of the program. So basically what happens, in case somebody missed it, is, you know, you file a claim, and then the insurance company will send you a slip of paper with a credit card number on it, and then you run that through your merchant terminal, which I think is incredibly unfair. And I think a lot of people are sometimes misguided by the actual cost of virtual credit cards, because they think it's so great. Oh, hey, we get all these payments from insurance. It's so easy. We just type them into the merchant or whatever, and then they're off. Well, remember, anything that goes through your merchant terminal is going to charge a fee, whatever your merchant fee is. So I've had a lot of clients complaining that their expenses have gone up. And I see some Facebook groups I follow. A lot of business owners, dentists in particular, are complaining that their credit card fees have skyrocketed. Well, if that's happening to you and you're taking virtual credit cards, that's exactly the reason why. Because what the insurance companies used to deposit directly into your bank account, they're not doing that anymore. Now they're sending it to you and making you pay for it to process the payment, or through checks. Now they're making you pay for it. One thing I would like to say before I say just say no is, if you are using virtual credit cards, make sure that you have a proper accounting code set up for that in your software. Some people will enter it simply as an insurance payment. Well, an insurance payment is a very broad payment method, or there are very broad payment methodologies. I mean, it could be direct deposit, it could be check, right? It could be a VCC. So make sure you have a separate payment method, insurance credit cards, right? So that you can track that. Let me also point out to you that I'm not going to tell you how, because I'll get in trouble. They will be mad at me, but it's actually very, very easy to steal a virtual credit card number, right? Remember, that's kind of like a pre-loaded debit card, or kind of like a gift card, right? With money on it. So don't allow yourself to be fooled into a comfort zone and by thinking, well, if I'm getting my payments through virtual credit card, those payments can't be stolen from me, because they absolutely can, and they absolutely can very easily, right? So that's what I'm gonna say about that before I get in trouble. But here's the main thing. Insurance companies will tell you that they've switched to this form of payment and that you have no other choice. And in most cases, depending on your state, that is absolutely not true. So just say no, you want direct deposit, or you want it mailed to you in a check.
Yeah, these are a monumentally dumb idea. And I get why they're convenient for insurance companies, but that's not a reason for you to get involved. Just a reminder that if you have questions, we'd love to answer them. We're getting very close to the end of our kind of formal part of our presentation. So if you have questions, please stick them right in that Zoom feature and we'll get to them in just a couple of minutes. A few things to wrap up. First of all, we have seen how people steal change in the past year. Will it go back to the way it was? Probably to some degree, but there's definitely been a shift that's kind of been pandemic driven and driven by people's circumstances. Secondly, and you've heard these as kind of recurring themes tonight, dividing up duties is important. Outsourcing certain things can take the burden off you as a practice owner to kind of become a part-time accountant in your practice. And let's never forget the concept of just business common sense. When Amber was talking a few minutes ago about refunds and saying do it by check and not by credit card, one of the reasons is it's very hard to look at your what's called your merchant statement. So this is the statement that the company that processes credit cards for you each month sends you, and figure out where the chargebacks that you see, the negative items on that statement, what they actually mean. On the other hand, when a refund is done by check, it's pretty easy to see where the check went. So a lot of the protection comes from some common sense. And finally, I'll mention that we're here to help. And people think of us typically as a company that investigates when embezzlement is found or suspected, and we absolutely do that. We also do a lot of work with practices in helping them set up systems that protect them properly from things like embezzlement. So if you're interested in either topic, we'd love to hear from you. There's an email that's going out to you in just a few minutes that will tell you things like how to access your continuing education credit for tonight. You can do all that right online. And there's also a button there if you'd like to talk to us, and we're always happy to have that conversation. So it's time for questions. Amber, why don't you tell them what we're going to be doing next month? Because it's pretty neat.
Yes, most definitely. I'm excited for next month, which is probably why I started talking about that first thing of meeting. But we're going to be talking about master your practice finances. And so we really want to teach practice owners and teams some great tools on how to master that piece of your practice. I feel like, as my experience on the clinical side, we really focus on mastering, clinical things and production. So we wanted to be able to bring our audience some great tools on mastering your practice's finances.
That's part of it, but there's the other part too. We're going to have a fantastic guest next month. He's actually an in-house guest. He's one of our team at Prosperident. His name is Scott Clifford. And if you're a webinar regular with us, you've seen him probably 3 or 4 times. Scott is working on this absolute humdinger of a case right now. And he and I were kicking back and forth the final report today. This is a multi-million-dollar case. The damage to the practice is probably in the $2 million range. And how it happened is instructive for every practice owner. I mean, there are some kind of specifics to the case that may not apply to you, but there's a whole lot that could happen in any practice. So Scott's going to be our very welcome guest. He is, if you've seen him speak here before, what comes out of his mouth is almost always priceless. So we're super excited to have Scott back with us next week, or next month. Our contact information is there if you want to talk to us, and Amber and Wendy normally monitor the questions that come in. Is there anything that you want us to kick around today, ladies?
Yes, I have one. There's a client or a participant that said that they have had insurance companies tell them that if they do not accept the VCC cards, that they will not pay us. What is your opinion on that, Dave?
The best answer to that is check your state law. I'm not aware of any state in the US, or for that matter, any province in Canada, where somebody you deal with can force you to accept payment by credit card. Because that's really what they're trying to do. The legal concept is what's called legal tender. And the question is what constitutes satisfaction of a debt? I don't think anybody can do it. Certainly check with your attorney, but the insurance companies want you to do this. It's a very cost-effective way for them to deliver you the benefits. So they're trying to force you, and they will strongly suggest to you that you need to do this, but I don't think that's actually the case in any state.
Okay.
Great question.
That kind of relates to credit cards. If a patient paid by credit card, the practice has paid a fee. So this practice does refund to the credit card they used so that they can try to reimburse that fee that they have already paid. What is your opinion on that?
Yeah, that's interesting. The credit card companies have some funny rules on that. And in a lot of cases, the rule is that if you refund a fee within the same month that it was charged, then they will reverse the merchant fee on the initial payment. So if somebody pays you $300 on April 5th, and then you process a refund to the same card of $50 on April 12th, in that case, you only pay the merchant fee on the net amount, which is $250. And the rules vary a little bit from company to company, but in general, if the same refund were processed 2 months later, you don't get a reduction in the credit card fee because of it. So, if somebody pays you by credit card and then they say 2 minutes later, oh, look, I changed my mind. I realized I'm going on a trip next week and I don't want to tie up my balance. Can you reverse the payment and let me pay you by check instead? That's a case where doing it makes sense and you would avoid the merchant fee. On the other hand, if you're issuing somebody a $50 refund 6 months later, in the way most credit card companies calculate their fees, you don't get relief for that one. The other place, I'll add one more thing. The other place people get burned on that sometimes is chargebacks. So somebody pays you by credit card, and let's say it was a stolen credit card. So eventually, and it takes a little while, but eventually you get a reversal of the original payment. And the merchant company charges you the percentage when the patient pays you first. So, somebody has a bridge done and it's $4,000 and they pay you with a stolen credit card. You pay a merchant fee on the $4,000. Then a couple of months later, this all comes out and you get a chargeback for the $4,000. What the merchant company doesn't do typically is refund the processing fee on the original payment. So that ended up costing you, something like $4,200 instead of $4,000. So it sucks.
I'm sorry. I want to ask some questions, but hold on. I'm trying to manage like answering questions and typing and all that, but instead of answering the question, I'll just ask you. Okay, so Miranda wants to know, is there a way to embezzle through multiple debit and credit adjustments on accounts? I think that might be one you might want to answer privately, right?
Yeah, okay. First of all, hi, Miranda. Thanks for asking a great question. Why don't you reach out to me tomorrow or next week, and we can have a little more in-depth conversation. I mean, yes, there's certainly a way to steal from that, but I don't know that it's something we want to go into a whole lot of detail on here. But Miranda, my phone number's on the screen. Please feel free to reach out when it's convenient for you, and we can talk about that in a little bit more depth.
Okay.
Thank you for being in our audience.
She said that makes sense. Thank you. We're not here to teach people how to steal, right? We're here
no, most thieves are already pretty good at it. They really don't need our help, Wendy.
Okay, here's like an ortho friend of mine. What is the best biometric reader for Orthotrax software? And although Orthotrax is one of my favorite programs to work with, I don't think I have an answer to that question. Do you, Dave, or should they just contact Carestream?
That's what I was going to say. Carestream will, I mean, first of all, the biometric readers have gotten pretty generic. I mean, there was a time when these were really expensive and really fussy to work with. And now they're just, you know, they plug into a USB port. They're pretty much plug and play. So I think asking Carestream is a good idea, but I also predict that Carestream is going to say, look, just, you know, go buy whatever one you want, and it'll likely work with our software.
Okay. And I have one other. Oh, yeah. So Barry is like just as brilliant as we are. So he made a comment and he said, you'll never be able to stop anyone from embezzling. A higher pay rate won't change the greed or the need. The only way to mitigate embezzlement is to understand your business practice and pay attention to everything that happens on a day-to-day basis. Ooh, he gets it.
Wow. Barry, if you ever want to make a career change, I think you'd fit in really well here. That was incredibly profound and expressed better than I could ever hope to say it. Yeah, you know, if somebody gets to the place where they wake up one morning and decide that stealing from their doctor is what they should be doing that day, they're going to get away with it for a while. And the real variable is how quickly you catch them. And Barry's advice is 100% on the money. Wow, I'm just marveling at how well that was said.
Yeah.
I'm glad that question's written down, because, you know, I will quote Barry going forward.
And since we're on that topic, someone had asked earlier, what percent of dental businesses will be embezzled from? You want to take that?
And folks, we'll make this the last question because we're just at time. If you did ask a question and we didn't get to it in the session, we'll certainly reach out to you after, or feel free to contact us. What we have seen about embezzlement in the last decade is that it has been increasing in practices. So there are kind of two measures that you can take. You can ask a group of people, have you been embezzled from? And you get an answer. That tells you the past. It doesn't really tell you about the future. In other words, if I ask that question and 48% of dentists say no, they haven't been, or yes, they have been embezzled from, the other 52 have some probability of being embezzled later. So the easiest answer to give you is one based on a historical percentage, but that doesn't really tell you how likely you are to be hit in the future. The ADA has done a couple of surveys. One was done in 2007, one was done in 2018 with the results published a year later. The 2007 study said that 35% of the respondents had been embezzled. The 2018 study said 48%. So over about a 12-year span, the percent of people who have already been embezzled went up about 12%. If you ask me what the lifetime probability of you being embezzled is, it's probably around 80%. So the reason we talk about the things we do is to protect this group, because you do face a significant risk. And yet there are a lot of things you can do to help yourself. And what we talked about today is some of them. We have a product called Office Protection System that's designed to help you find the weaknesses in your practice and lock them down. That's a part of our world that Amber Weber is very involved with. So you're not helpless against this, even though it may seem that way sometimes. There's a lot you can do. That's probably a great place to wrap up for tonight. I'd love to thank my delightful co-hosts. We have so much fun putting these things together and delivering them. I mean, I can't believe how giggly Wendy was tonight. She always has fun, but tonight really seemed to hit it with you, Wendy. And it was just terrific to see that. I'd also like to thank our audience because you guys are the reason we do this. So we're back in just under a month, May the 20th. I mentioned our guest presenter, Scott Clifford. He is just a terrific guy to listen to. Like every time I hear him speak, I come away just marveling. So thank you very much. Please be safe wherever you are, and we'll see you in just about a month. Good night, everybody.
All right. Night.
This concludes this episode of the Prosperident webinar series. The team will be back soon with more tools and ideas. If you have questions about this webinar, if you would like to discuss your practice with one of us, or if there is a topic you would like to see in a future webinar, we would love to hear from you. You can contact Prosperident through its website, www.prosperident.com, or by calling 888-398-2327.